Roth conversions are one of the most powerful tax planning tools available to retirees. But done wrong, they can trigger a cascade of hidden costs that wipe out the tax savings entirely. Today we are going to walk through everything you need to know about Roth conversions in 2026, including the exact bracket math, the traps that catch most people, and the strategies that actually work. Welcome to the Retirement Classroom. If you are new here, we publish deep dive retirement education videos every week. Hit that subscribe button so you do not miss a single one. Before we get into the details, a quick note. This content is for educational purposes only and should not be considered individual financial guidance. Everyone's situation is different. Please consult with qualified financial professionals before making decisions. If you are looking to speak with a retirement professional about your unique situation, scan the QR code on screen or check the link in the description. Let us start with the basics. A Roth conversion moves money from a traditional pre-tax account like a traditional IRA or 401k into a Roth IRA. You pay income tax on the converted amount now. In return, that money and all of its future growth will never be taxed again. No taxes on withdrawals, no required minimum distributions, and your heirs inherit it tax-free. The big news for 2026 is that the tax brackets we have had since the Tax Cuts and Jobs Act are now permanent. The One Big Beautiful Bill Act, signed on July 4th, 2025, locked in the current 7-bracket structure. The rates are 10, 12, 22, 24, 32, 35, and 37%. For married filing jointly, the 12% bracket ends at $100,800. The 22% bracket ends at $211,400. The standard deduction for married filing jointly is $32,200. For single filers, the 12% bracket ends at $50,400 and the 22% bracket ends at $105,700. This permanence changes the Roth conversion calculus. Before the One Big Beautiful Bill, there was urgency to convert before 2026 when brackets were scheduled to revert to higher rates. Now, there is no cliff. You can plan a multi-year conversion strategy knowing these brackets will hold. That is actually good news because it lets you be more strategic rather than rushing. The core strategy is bracket filling. Here's how it works. You determine your taxable income for the year from Social Security, pensions, and other sources. Then you calculate how much room is left in your current tax bracket. You convert exactly enough to fill that bracket without spilling into the next one. For example, a married couple with $40,000 in taxable income has $60,800 of room left in the 12% bracket. They could convert up to $60,800 and pay only 12 cents on every dollar. If they converted $80,000 instead, the first $60,800 would be taxed at 12%, and the remaining $19,200 would be taxed at 22%. The 22% bracket is often the sweet spot for Roth conversions. For a married couple, it spans from $100,800 to $211,400. That is a $110,600 window. If your base income is low enough, you can convert substantial amounts while staying in the 22% bracket. Many financial planners consider 22% an attractive rate to lock in, especially for retirees who expect future RMDs to push them into the 24% bracket or higher. But here is where most people get into trouble. A Roth conversion does not just affect your tax bracket. It triggers a chain reaction across at least 3 other parts of your financial life. First, the Social Security tax torpedo. Social Security benefits become taxable based on your provisional income, which is half your Social Security benefit plus all other income, including Roth conversions. For single filers, if provisional income exceeds $34,000, up to 85% of your benefits become taxable. For married filing jointly, that threshold is $44,000. In the torpedo zone, each additional dollar of conversion income can create up to $1.85 of taxable income. That means a retiree in the 22% bracket could face an effective marginal rate above 40% on conversion dollars in this zone. Second, the IRMA surcharge. Medicare premiums are income tested with a 2-year look back. Your 2026 income determines your 2028 Medicare premiums. The first IRMA threshold for single filers is $109,000 of modified adjusted gross income. For married filing jointly, it is $218,000. Cross that line and you pay an extra $65 per month per person for Part B, plus $14.50 for Part D. Cross higher thresholds and the surcharges stack dramatically. At the top tier, you could pay over $335 extra per month per person. A large Roth conversion that pushes you over an IRMA cliff can cost thousands in extra Medicare premiums 2 years later. Third, the pro rata rule. If you have any pre-tax money in traditional IRAs, SEP IRAs, or simple IRAs, You cannot cherry pick which dollars to convert. The IRS treats all of your traditional IRA money as one pool. If you have $90,000 in pre-tax contributions and $10,000 in after-tax contributions across all your IRAs, then 90% of any conversion is taxable. You cannot convert just the after-tax portion. This catches many people attempting the backdoor Roth strategy. Now let us talk about timing. A Roth conversion must be completed by December 31st. Unlike regular Roth IRA contributions, which can be made until April 15th, conversions have an absolute year-end deadline. Most financial institutions set their cutoff at 4 p.m. Eastern on the last business day of the year. Do not wait until the last week of December. Plan your conversions by November at the latest. Each conversion also starts its own 5-year clock. If you convert $50,000 in 2026, you cannot withdraw that specific converted amount penalty-free until January 1st, 2031. Note this only matters if you are under age 59 and a half. Once you reach 59 and a half, the conversion 5-year rule no longer applies to the converted principal. However, the earnings 5-year rule still requires that your first Roth contribution or conversion be at least 5 years old before earnings come out tax and penalty free. One of the most powerful Roth conversion strategies is converting during market downturns. If your IRA drops from $100,000 to $75,000 during a market correction, you can convert at the lower value and pay tax on $75,000 instead of $100,000. When the market recovers, all that growth happens inside the Roth, completely tax-free. You have essentially bought $25,000 of future tax-free growth at a discount. State taxes matter too. 9 states have no income tax: Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, Wyoming, and New Hampshire. If you live in California, you could face a combined federal and state rate of over 31% on conversions. If you are planning to relocate to a no-tax state, coordinating the timing of your move with your conversion strategy can save tens of thousands. Under Secure Act 2.0, there is one major change for 2026. If you earn more than $145,000 in wages and are age 50 or older, your catch-up contributions to workplace retirement plans must now be made as Roth contributions. You can no longer make them pre-tax. This applies starting January 1st, 2026. Also starting in 2027, Roth balances in workplace plans will be excluded from required minimum distribution calculations, making Roth conversions even more valuable for long-term planning. Here's the key framework for deciding how much to convert each year. Start with your projected taxable income. Add half your Social Security benefits. Check where you fall relative to the Social Security taxation thresholds, your target tax bracket, and the IRMA cliffs. Convert up to the point where the next dollar would push you over a cliff or into a bracket you find unacceptable. Repeat every year. This phased approach typically saves far more than one large conversion. If this breakdown helped you understand Roth conversions, hit that subscribe button and turn on notifications so you do not miss our next deep dive. We publish new retirement education every week.
Hey, before you go, if you're serious about your retirement, we'd love to help. Scan the QR code on screen right now or visit the link in the description to book a completely free strategy session with a qualified professional. It only takes a couple minutes to fill out, and there's absolutely no obligation. Take the first step today. We'll see you in the next one.